Again, I want to thank you all very much for joining us. Now, to kick off the webinar, I'm delighted to introduce the webinar moderator, Elizabeth Rhine, the Managing Director of the Center for Financial Inclusion at Axiom International. Welcome, Beth.
Good morning. Thank you, Sarah. Good morning, afternoon, and evening to all of you joining from around the world. Welcome to the Center for Financial Inclusion's webinar on the draft guidance on financial inclusion from the Basel Committee. I'm Beth Rhine, the Managing Director of the Center, and we're really delighted to have so many participants signed up for the webinar from over 30 countries. I think the strong response we've received to this invitation just underscores how important the Basel Committee guidance may be for the future of the financial inclusion movement. We're delighted to bring you the wisdom of a very distinguished panel, starting with Dr. Daniel Szydlowski. Dr. Szydlowski is a highly regarded economist who has extraordinary credentials in both academics and government service. He's just recently completed his term as Superintendent of Banks and Insurance of Peru, which is one of the most highly regarded banking superintendencies in Latin America, if not the world. And according to the EIU Global Microscope, it is the #1 in the world. Danny has been a very active champion for financial inclusion. And at our request, he's been preparing detailed commentary on the guidance, and he'll share some of the most important points with us. His commentary is very detailed, and we'll be just hitting some of the highlights. But his longer paper will be available subsequently and will be submitted to the Basel Committee as input. So we're also very excited to have Dr. Ndung'u, who also combines a brilliant academic career with public service. Currently, Dr. Ndung'u is a visiting fellow at the Blavatnik School of Government at Oxford. But more important for today's conversation, he was governor of the Central Bank of Kenya from 2007 to 2015. And of course, you know what took place during that time. In that role, he was instrumental in the blossoming of mobile-based financial inclusion, which has made Kenya a global focal point for the movement. So we've asked Governor Ndung'u to share his thoughts, especially on the digital finance aspects of the guidance. We're also delighted to be joined by Juan Izaguirre, who is a director on the work stream of financial inclusion, which was delegated by the Basel Consultative Group to prepare the guidance document. So he's a member of the team that drafted the document. He also comes originally out of the Peruvian superintendency, and for the past several years, he's been working at CGAP, the think tank housed at the World Bank, on global financial inclusion topics, ranging from deposit insurance for digital providers to consumer protection to many others. So in his role as one of the authors of the document, Juan Carlos gets the pleasure of attempting to respond to all the critiques that may come his way. One of the purposes of this webinar is to encourage all of you to give input to the committee. And so after we've heard from each of the three panelists, we'll turn to you to respond and try to respond to your questions and comments. We also encourage you to send us your comments after the webinar. And of course, we encourage you to send comments directly to the Basel Committee, who is eager to receive them. So we'll get started with Dr. Szydlowski in a second, but first let me just give you some brief background on the Basel Committee's work in financial inclusion and background on the guidance document. The Basel Committee began working on financial inclusion in 2008, really focused on microfinance. It produced guidance in 2010 that addressed microfinance. Then in 2012, through the Basel Consultative Group, which is the mechanism through which developing countries are involved in the Basel Committee process, the consultative group launched a work stream on financial inclusion, and that's what led to the current guidance document. What the guidance document does is it takes the Basel Committee's core principles as a framework to and applies them to the adjustments needed in regulation and supervision in order to take into account what's happening in inclusive finance. The document also has special annexes on consumer protection, anti-money laundering, alternative forms of supervision, and micro-lending. Right now, we're in the last part of a comment period that is open until March 31st. Guidance will be reviewed after it's all received, after all the comments are received by the work stream. The work stream will work on taking those revisions, revising, submitting them to the Basel Consultative Group, and finally, the guidance will be approved by the Basel Committee, aiming for a final version to be released as Basel Committee guidance in late 2016. So that's a little bit of the context for what we're doing today. So now I'd like to turn to Dr. Szydlowski to give us some of the highlights of his commentary. Are you there?
Thank you. Thank you very much, Beth. I appreciate being here, and thank you for everybody in the audience who's interested in this topic and would like to make an input. This guidance is really very important because it tries to cover the waterfront in making suggestions and providing wisdom on how to put together the concern for financial inclusion with the more traditional aspects of bank supervision and keeping the banking system safe. Now, it's such a comprehensive document. It's very hard to comment on these many things, because it is indeed a very wide and very useful and very good, and it has a lot of wisdom in it, and it's going to provide a lot of guidance. At the same time, it provides an enormous challenge to anybody who wants to actually implement it. The dilemma of the supervisor is that he has limited resources, particularly if he's in a small or medium-sized jurisdiction. If you are a middle-sized country, let's say you are Guatemala or you are Peru, or you're an island in the Caribbean, or perhaps an island in the South Pacific, you do not have unlimited resources to dedicate to supervision, and much less to financial inclusion. If you are Brazil, you are better endowed with resources. Brazil has more than 200 million inhabitants, and so it's able to gather together a quite large number of very capable people who can spend time on supervision, on financial inclusion, on everything that can keep a banking system safe and can keep it evolving in the right direction. But when you're a small jurisdiction, it's very difficult. How do you accomplish these many tasks that you're supposed to accomplish? Now, on top of this, when you add the load of innovation in digital finance, which is a revolution, it's probably the most exciting thing that's happened in the last 200 years in terms of payment systems. Since the invention of paper money, there hasn't been something with the kind of impact that digital finance is having. And now you need to understand, learn, and regulate and make sure that something totally new functions well, functions seamlessly, and serves the public. It's a major task, very difficult for small and medium-sized countries to cope with. Now, when you look at the guidance kind of assumes unlimited resources. It tells you all these many things you're supposed to do. But how in the world do you bring this down to something that's actually feasible and that fits into any kind of reasonable budget, either in people or in actual money? Usually, the bank regulators are paid by, financed by the systems they regulate. Every bank can pay something for being supervised. And so the budget is limited. And the financial system don't want to pay a huge amount, because they indeed then pass it on in terms of costs to their customers. So there's a real dilemma here. But the dilemma is not only of the supervisors. The dilemma is also of the supervisee. The units of the financial system that are providing the service and that are concerned with providing the inclusion. They have to comply with a large number of rules. And it turns out that the regulatory burden absorbs a very important fraction of their resources, of their capabilities. And of course, the units that are concerned with inclusion tend to be smaller units. They tend to have lighter administrations. They tend to have smaller budgets and therefore able to pay lower salaries. So it's the weak part, if you like. It's the less strong part of the system that's facing the inclusion challenge. So with fewer resources, with less capable resources, they're supposed to provide everything that's needed to bring the underbanked and the unbanked into the mainstream. The challenge is enormous. And we need to face this challenge. We need to understand it. And hopefully, in the next version, the guidance document will address these issues of operational constraints, both on the side of the supervisors and on the side of the supervisees, so that we can get better guidance on how to cope with this problem. Now, I have some suggestions as to how one might deal with this. And no doubt, the folks that have been working on the guidance will have already thought of some of these things. The most immediate thing that one can do is to provide more extra situ supervision. In other words, one can do more things off-site, the traditional way in which bank supervisors supervise is they go to the institution being supervised, they sit there and they gather the data. But now with computers and with statistical programs, it's possible to do this centrally. Doing it centrally provides two enormous benefits. First, you save time. Number two, you standardize. And number three, you can compare across institutions. It's possible with computer systems to detect the outliers. When you detect outliers, you save an enormous amount of time in spotting what's strange and what might be wrong. Now, judgment still has to be applied. The human element is absolutely indispensable. Otherwise, you have a garbage in, garbage out situation. Nonetheless, enormous savings in terms of skill, in terms of time, in terms of ability can be realized if you do computer-based supervision and you do a first cut of going extra situ. In other words, you collect the information off-site. But again, you have to be on site some of the time because you have to make sure that the data are accurate. The only extra situ computer-based supervision will only be as good as the data input that you receive. And therefore, it turns out to be absolutely crucial that the information fed into the computer system is actually accurate. Now, what then happens? The mix of skills that the supervisor needs to have and the mix of skills that the supervisee needs to have needs to change. Supervisors need to have more capacity in their statistical analysis. They need to have more people that are trained in doing off-site supervision. And this involves a change in the skill mix. On balance, this will generate savings. It will generate greater capacity to do what needs to be done, and it will produce better results. But it will involve an effort at change. It will involve an effort at reorganization, and it will involve an effort at no longer doing business as usual. Change is going to be needed. But of course, that's what technological change is all about. If we introduce something new, like digital finance, obviously there's going to have to be an effort to digest this. And digesting this goes along with economic financial inclusion, and that goes along with a change in the way we do business. Now, the next big issues have to do with the requirements of the digital finance revolution itself. As I said before, this is the greatest revolution that's happened on the payment side in the last 200 years. Now, the first thing that happens is that it's no longer so easy to know your customer, because the whole idea of digital finance is that you don't see your customer face to face. So we need to have another set of identification systems. You either need to have a national identification system, or you need to have a way in which you can make sure that at least you know who it is that you're dealing with, perhaps even at second remove. So there's a challenge here in how you do this, and part of the art is to use limitations on transactions where you can have small transactions and where not being so sure you're dealing with doesn't matter as much. By using a mix of risk and reward, you can actually lower the requirement you need from what's standard in a normal bank to something which is adequate for digital finance. The second big topic has to do with de-risking. There is a worldwide movement afoot which is producing a pernicious result, where the large banks find it too risky to deal with offshore correspondents, to deal with small people, to deal with small banks. The large core banks have found that the regulatory burden and the risk of being fined is so enormous that they prefer to turn down the business. But this has a terrible effect because it delinks. De-risking causes delinking of large parts of the financial system of small countries from the core finance system of the major world players. And this is totally inconsistent with the idea of financial inclusion. Now, why does this happen? Why are there these fines? They're the result of basically money laundering, of procedures that do not provide assurance that legitimate transaction taking place. But unfortunately, what's happening is that the impact of these measures and these cautions hits the little guy when, in fact, it's not the little guy which is a danger. Big money launderers are big people. They're big fish. And the folks that are being hit are the little guys that either are not money laundering at all or just going about the normal business, or whom you can catch quite easily. Somebody who does smurfing can be caught by any computer program easily enough. When you have 50 transactions going through the same account in 2 days, you spot that because it's very easy to spot. So anybody doing proper money laundering does not smurf. The smurfers are very little fish, and they're easily caught. The big money laundering, the big financing of terrorism, there are big people, and they need to be caught in other ways. De-risking is not an effective way of catching the bad guys. It's an effective way of destroying financial inclusion, and that's not the purpose. So there is an instrument being used here which has a byproduct which is not the outcome that you want. Now, the next topic that I want to touch on, and which is not dealt with to any extent in the guidelines or in the guidance, has to do with interoperability and interconnectivity. For a digital system to work well, you have to make sure that all of the telcos are interconnected seamlessly, and that all the financial institutions are interconnected seamlessly. That's the ideal system where everybody can play on the same terms, and it doesn't matter what household or business connected to which part of the system. They can all deal with each other. Now, this is not easy to accomplish. Many countries are trying. They're trying in different ways. There are obstacles along the way. And one thing that we don't know enough about and that requires more attention is how you actually get to that goal. Starting points are very different. Kenya has one starting point. Peru has a different starting point. Tanzania has a third one. India has a fourth one. The Philippines. Everybody has their own starting point because initial conditions are different everywhere. But yet we want to converge on the same goal. So we need a lot more research. We need a lot more guidance on how to get from where we are to where we want to be. The goal is clear, but how to actually get there is far from clear. That is something that requires a lot of work on. It requires guidance. It would be valuable to have this highlighted to a greater extent in the guidance that we're discussing. Now, finally, there is the issue of costs and economies of scale. Uh, Systems that are computer-based and that are digital have enormous economies of scale. In Peru, my country, we have just introduced a platform, a single platform, interconnected, interoperable for the whole system. And it's been clear to all the participants that if we don't get quickly to 5 million users, we will not be realizing our economies of scale. Now, if Peru needs a system for 5 million users and it's going to be at 10 million, cost would be even lower. What happens to a country that does not have this size? So the real issues here of how to succeed in smaller countries and not lose economies of scale. It's even more important to realize that you really want to have everybody signed on to the same platform, because the economies of scale are overwhelming. If the platform is divided among 3 or 4 users, costs go up very, very much. And so economies of scale dominate in this industry, and that poses a whole set of problems. From how you price, marginal cost pricing. There are lots of precedent, lots of theory about how you do this, lots of practice as well. And there are issues, perhaps, which spill over into more than one country. Consider French-speaking West Africa, which has a monetary union. There you have a case where there may be an argument for having a single system in all of Francophone West Africa, because with a single currency, it's fairly easy to have a single payment system. At least much easier than other cases where the economies of scale will also dominate. Now, finally, I want to raise the issue of bringing down the costs of inclusive finance. It's well known that the big companies pay a lower interest rate than the small companies. A brewery in Peru will borrow at 4 or 5%. A small enterprise will borrow at 20%. Consumer finance ranges anywhere from 50% to 120%. This kind of dispersion is not unusual in many countries. But if we want to have inclusion, we need to have interest rates come down. We need to have the cost of inclusive finance be much closer to the cost of standard finance. Now, how can you get there? This requires costs to come down in those parts of the financial system that operate the inclusive finance. Small banks, small savings and loan associations, some NGOs, some municipal banks, whatever the nature of the institution might be. Now, there are basically three types of programs available today which might move us in that direction. They might not get us the whole way, but they're a start. The first of these is industry-wide procurement. There are enormous economies of scale to be achieved when a group of financial institutions purchases together, starting from having a single banking core, which generates enormous economies, to buying inputs. If you're going to have purchase motorcycles because you have to go out and visit your customers, have an industry-wide procurement where all the motorcycles are bought in one fell swoop. You'll get much cheaper price because you'll have a single competitive bid. Even pencils are cheaper to buy if you buy them collectively. So industry-wide procurement is an instrument for bringing costs down, and those lower costs then get passed on to the borrower in terms of lower interest rates. The second instrument is outsourcing for economies of scale. When you outsource services, you can get enormous economies. Some of the large banks do that themselves. Inside the multinational banking system, they concentrate bookkeeping activities, back office activities in very few countries because they realize that doing it centrally turns out to be much cheaper. The same thing can be used in the area of inclusive finance. It's not the usual. Everybody likes to do their own thing. They like to have control of their own system, and yet outsourcing will bring costs down significantly. And if the costs don't come down, we have consequences, because if the costs are high, the interest rate charge is going to be high, and that's going to generate exclusion. A true inclusion involves bringing interest rates down to a level closer to, if not comparable to, what the large companies pay. Finally, there's a third and even more modern technique that can be applied. It involves doing risk assessment with psychometric techniques and with big data. There has been recently a lot of development in this area because now we have the computer capabilities and we have the techniques available that can be applied. They are new, so they're not tried and tested and true, but they're very promising. If we can test the reliability and the honesty of a person we want to hire for our company through a psychometric test, we can also test whether somebody is going to be an honest debtor and is going to be willing to repay his loan. He may not be able to because circumstances may prevent him, but we're going to be able to test whether there's a willingness to repay, whether there's reliability. In the same way, if somebody is associated with other people who are good payers and are responsible, that probability is very high that indeed they are responsible too, because people associate with like people. And so the statistical instrument called the central limit theorem is extremely helpful in identifying within groups of large numbers who is similar and who is dissimilar. And so it's possible to segregate the outliers and concentrate on the folks that are not outliers, that are indeed located in the center. This lowers risk, and by virtue of lowering risk, it lowers the price that has to be charged, and the price is the interest rate. And so repayment rates will go up. A better segregation of the high risks is going to be effectuated, and as a result, the interest rate paid by a large part of the newly incorporated citizens that are supposed to be financed by financial inclusion are going to be better treated. So we have some issues that it would be worth expanding on, in the guidance, and we have some specifics that it would be nice for the guidance to elaborate on. Now, what's the final message here? The final message is that the guidance needs to highlight much more a dynamic dimension. As it stands now, the bulk is how to do things well today. We need to know more about what the guidance can tell us about how we can do things better tomorrow and as we evolve to tomorrow. Supervisors should keep the financial system safe. That indeed is their main function. But they also need to help the financial system modernize, to become more inclusive and to serve the public better. That function is the dynamic function. And it is very important because it ensures what happens tomorrow. It's important in this context to be aware that the financial system has a problem of legitimacy. A large fraction of the population believe that banks are not their friends, that they were going to be abused when they go to a bank. That generates a legitimacy problem which is harmful to a market economy. We need to have a system where people trust their financial system, where they believe that their financial system is their friend and their aid. And that requires a different approach, and it's part and parcel of serving the public better. Now finally, what's important with supervisors to do is to bring about digital finance as soon as possible. The benefits of digital finance are enormous. Using cell phones to make payments and to receive payments is enormous increase in efficiency, an enormous increase in productivity. The sooner this can be realized, the better. I would like to urge the committee producing the guidance to spend some additional pages on this topic and provide us with some help on how we can move forward more effectively and more efficiently towards this goal. The quicker we get there, the more we are going to have firm and inclusive financial system. We're going to have made it safer because we're going to have made it more legitimate. Ladies and gentlemen, thank you very much. Beth, over to you. Hello?
Yeah.
Yes, I'd like to.
Moderating, yeah.
Yes, I'd like to turn now to Dr. Ndung'u. Dr. Ndung'u, you've been a pioneer in the digital financial inclusion space, and you're also able to bring a different regional perspective from Dr. Shedlowski's main experience in Latin America. So what are the issues you would like us to consider today? Please go ahead.
Thank you very much, and thank you, Daniel, for being so comprehensive. And I think I'll pick up some of the points that Daniel has raised, because essentially, I think the conclusion he has come up with is that we want to lower cost of finance. If you want to come up with inclusive growth, inclusive finance, what we need to encourage is actually digital finance. So the next, we go back to where he started. What we need in digital finance, one of them is capacity. I think there are capacity constraints for the regulator. There are also investment requirements for the supervised. So essentially, the DFS, the Digital Financial Services, is really a big environment out there. And we need to see and to show how the regulators can cope. But even before we get there, because I think Daniel ended with a very strong point, very nice point, a Basel report is actually to regularize how the market should adapt to a frontier technology. So we need to come down first and start defining what is DFS and how countries should adapt to the digital financial services. So many countries have taken up their own, should I say, frontier on the basis of the legal jurisdiction that is permissible in their own countries. But we would like a report like this to come and regularize and say, this is how digital financial services is working. This is what would encourage. These are the norms. This is what we need to do. Then we can sync back to operational issues, capacity constraints, and what kind of resources are required to raise the appropriate capacity to supervise the market once digital financial services have been taken up. One of my biggest problems has been not only resource constraint, but also the unquantified so many fears with the regulators when digital finance is mentioned. There's so many things that we worry about, so many unquantified things that are talked about, but they never come true. So essentially, from a supervisory point of view, we need to come down and say, ICT platform has been there with us. We have had off-site inspection and inspection. So essentially, it's a question of how do we devise methods of trying to bring down ourselves to cope with the market, the dynamics in the market. Now, that's the first point. That is, we need to regularize, and secondly, we need to see how we cope with the innovations in the market. By the way, the digital financial system is changing every day. Let me give you some highlights in terms of where the evolution is. I'm here. 2 weeks ago, I was talking about where is the frontier. The first thing you realize in digital financial services is that it revolutionized the way we think about payment system. It revolutionized the way we think about liquidity distribution. And some of the papers I've seen also from academics is that payment system and even liquidity distribution can take place outside the banking sector, and it is safe, it is transparent, it is effective, and it is efficient. That's one of the most important regularities that we have seen. So essentially, those fears that systemically important payment system that actually violates some of the rules is that they can be contained, and this is something that we are seeing. So the first generation of digital finance dealt with payment system and remittances, which together with liquidity distribution made sure that you can actually decide the operating line. The second revolution was that you can actually develop virtual savings account, virtual banking within the same framework. The third one is that you can use the data from savings, virtual savings account and transactions and use that for credit scoring mechanism. And Kenya is a good example. So essentially, you are capable of changing the technological, the collateral technology in use, and that has been very, very important. And finally, now the frontier is where we are saying we can actually use the same DFS to encourage cross-border transactions and even international remittances. Those are the four aspects that we are looking at. And we are going to see a lot of revolution and evolution in this. So the regulators must themselves sit back and define what do we do, how do we cope, and secondly, what are the norms, what are the rules. So a Basel report like this should look at all those frontier issues so that it gives us some idea in terms of what we need to do. Let me go to the third point. Of course, if the DFS technology is with us, then it means that technology is changing, and technology is changing in the market. So it means that the regulators must change. And this is very, very important because most of the time the regulators prevent innovations because they don't know how to change, they don't know how to move. Here, I would maybe move out of my heart and say, look, there is no harm in creating partnership with those innovating in the market. Partnership will help us overcome some of the capacity constraints that I believe has prevented some innovations in some countries. By the way, when I talk about this, Daniel and I have been in Alliance for Financial Inclusion. And within Alliance for Financial Inclusion, we have also created African Mobile Phone Financial Policy Initiative, AMPI. And it is to encourage digital financial services in Africa because Africa needs it because of inadequacy of infrastructure. Trip to the bank is very, very expensive. Inadequacy of institutions. So essentially, digital finance can reach, you don't have to have a trip to the bank. And this is where most of them use payment system. And this payment system, if you have to make a trip to the bank to make transactions, becomes very expensive. And that's why it is becoming very important. So we have to say that it is coming back to us. We have to see how we adopt it. We have to see how we improve on the efficiency of regulatory capacity. And this is where the digital financial services will come in. So the renewed thinking is that let's think about partnership. Partnership between the regulator and the regulated, partnership between international organizations that have the technology, that have the upper hand in understanding what is happening, partnership with institutions that are providing the technology. In fact, that is where it is very, very important. Telcos have provided this technology. They had the capacity, so it was so easy for them to invite those who wanted to work in the financial system because they had that extra capacity, and it was so easy. So if we partner with them, we are going to understand what is happening. Let me go now to some details about supervision, like the KYC. I think, for me, the digital financial system is going to improve the KYC. It means that you have a versatile system. You can come up with any form of biometrics that you want to perform, and you can link up all that data to national data system. For example, identification system. We did that in Kenya. You can type your identity card, identity number, and then all the biometrics can come up. The second thing is that for us to improve and enlarge the market, that is inclusive finance, we have to work out in terms of what interoperability will help in terms of ex post. We have argued not enforce interoperability ex ante because then that may kill the innovations. So it means that this is cost effective, and then the national payment system is going to be very, very effective. For those of us who fear the AML CFT regime, digital financial services has been seen, and we can show it and prove it that it has improved the AML CFT regime in a big way because you can actually monitor transactions, they are transparent. You can monitor movements of funds, they are transparent. But when we allow informal finance or informality of market, then it means that we are never sure about our AML CFT, and this is something that we really need to emphasize. Of course, when I say that, is that I can quote a paper by Michael Crane and Mayer here in Oxford, which is a World Bank working paper 2011, that the lesson, especially from the Kenyan M-Pesa, is that you can unbundle some of the core activities of the banking system, and they can be perhaps be provided outside the banking system with ease, like the payment system, like liquidity distribution. The fourth point I wanted to make is about supervision. It is true we would like to have safe and sound financial system. We want to modernize the financial system to make sure that it is inclusive. And we also want to embrace that system that allows us to clearly be at the frontier. What we didn't know is that the DFS has brought cost of financial services down. Financial inclusion is real when you use digital financial services. It is cost effective because essentially it is going to encourage a mass market. And this is where we would like to make sure that we dwell on our technology. And then, how do we come up with guidelines to regulate that kind of market? I believe we can manage to do that. I believe we can. We have seen good, clear examples in terms of where it is working. I believe that we have seen countries without any form of payment system working out to have a better payment system. So it's a question of looking at how we are going to change the market. And as I explained earlier, we have seen that it can bring cost of inclusiveness in financial system down. For example, the collateral technology I mentioned is a very, very powerful tool that we are now in Kenya using the data on transactions, data on savings to analyze your credit scores, and with that, you actually can change the collateral technology that has inhibited entry into the financial system, credit supply in financial system. So essentially, there are several points that I thought what Daniel did was to actually push a very comprehensive framework. But what I've decided is to add some aspects in terms of how we cope with the technology, because it is there for us. If we believe that we want to push the public policy on financial inclusion, then it means that we have to come up with a way that we embrace, first of all, technology. Secondly, we show how we cope with the innovations in the market. And thirdly, how we create very strong partnership system, or even with the actors in the financial system. Once we have done that, we'll be sure that we are going to deliver the financial inclusion strides that are commensurate with the developmental goals that we are looking for. I think I would like to stop there maybe, and we can talk about specific issues as they arise. Thank you very much. Back to you.
Thank you very much, Dr. Ndung'u. That was really interesting commentary on putting aside unnamed fears and going forward with experimentation in a bold way. And as we turn now to the committee itself, and Juan Carlos Izaguirre, Juan Carlos, you have the challenge of responding to what these folks have said. And I would also just pose the question of, as the Basel Committee has been the guardians of risk mitigation in the system, in the financial system, and here we're seeing a plea for looking to the future and experimentation and moving forward. How do you reconcile those two things? Please go ahead.
Sure. Thank you very much, Beth. And thanks a lot to the Center for Financial Inclusion for organizing this very important and useful webinar, and for inviting ZIGAP as the Vice Chair of the Basel Consultative Group's Financial Inclusion Workstream. Firstly, I would like to start by very brief comment, but start by commending, I think, the Basel Committee for this effort to provide for the first time a guidance that is quite comprehensive on a topic that has not been typically addressed by the Basel Committee, this topic of financial inclusion. And as Beth mentioned, this has been a work in process since practically 2012. Just for extra benefit of those participating in this webinar, back in January 2015, the Basel Committee published a range of practice report on the application of Basel core principles to the regulation and supervision of activities and institutions relevant to financial inclusion. And this provided the responses by 57 countries and territories on the way they regulate and supervise financial inclusion relevant topics. And this provided a really useful input to the workstream and the Basel Consultative Group to start developing this guidance document. The process to develop the guidance has been quite extensive and intensive throughout 2015. I think it's important to highlight also the leadership of the Central Bank of the Philippines as the chair of the workstream on financial inclusion, and the role of other important representatives, both at internally the workstream on financial inclusion and then at the Basel Consultative Group level, including the World Bank, the Association of Bank Supervisors of the Americas, as well as other representatives from a wide range of countries that include Peru, Mexico, Malaysia, and others. So after that, I would like to highlight also the importance of this document as a milestone document that practically for the first time recognizes that it's not only the role of supervisors to push and to promote a safe and sound financial system, but also to look at topics such as financial consumer protection. For the first time, a Basel Committee document recognizes the importance of financial consumer protection for promoting financial stability and includes an annex on this topic in a guidance document. It also recognizes the linkages of financial inclusion, financial integrity, and of course financial consumer protection as key elements that have a lot of influence on the financial stability. So having said that, I want to go and address the comments, very great comments that both Danny and Njuguna have provided in these past few minutes. And first of all, agree completely with, I think, all of the topics they have addressed, and indicate that internally at multiple stages of discussion of the guidance document, we have addressed all these issues. And I think we have tried to mention them in several parts of the document, of the guidance document, but we can see that probably in some cases we could be even stronger or even clearer on some of these topics. I would start by the point of supervisory capacity. I think we all recognize that currently nowadays prudential supervisors have a big challenge in their hands. Both the range of practice report and the guidance document recognizes that now more than ever, prudential supervisors have multiple roles and functions in their hands. In many cases, they have responsibilities for all these topics: financial inclusion, consumer protection, financial stability, financial integrity, sometimes even competition, and even financial education. So the wide range of topics that financial supervisors have in their hands is particularly significant. At the same time, they have to cover multiple types of institutions, multiple types of providers. And I think for the first time, the guidance document from the Basel Committee in a way recognizes the importance of supervisors to look at all these multiple types of entities and recognizes the role of non-bank providers in promoting financial inclusion and in playing a role in the offering of multiple financial services. So you could see that non-bank e-money issuers, deposit-taking microfinance institutions are recognized as important actors in the financial sector overall. So again, for the first time, the Basel Committee is trying to look at not only typical commercial banks, but also the role of non-bank type of providers. But of course, this opens the question of the extensive supervisory capacity challenges. The guidance document has tried to address this topic from different angles. One of those is the recognition that there could be multiple approaches to supervision. Explicitly, the guidance recognizes the possibility of supervisors not only to do on-site supervision, but also to use different approaches, such as the collective approach, the auxiliary supervision approach, or the role of other entities that can partner with the prudential supervisor to look at all these multiple types of entities, especially those small providers that are often located in different and isolated provinces and locations that are difficult to reach by the supervisors. So there's an initial recognition on the use of different approaches, even the recognition of possibly relying on external experts to provide inputs to the supervisor. The guidance also is including and recognizing the importance of market monitoring. So not completely on-site or even off-site supervision, but a way to look at how the different actors are operating in the system, even using indirect types of sources of information, which could range from reports that are being available by other actors that the supervisors can look at indirectly, or doing some more kind of a light supervisory approach to look at those supervisors that may not be systemically important, but still the supervisors may have at least an indirect or an overall market view to them. I'm completely agree with Daniel's emphasis on the role of off-site supervision, and I would agree even further with his comments on recognizing the aspects of technology. And I think there could be even more a more specific statement within the guidance. I don't think we have completely addressed the role of financial technology tools that can be used by supervisors. And I'm talking now about what is called fintech or regtech developments right now that could be extremely important for supervisors to use in their day-to-day work. I would like to, at the same time, address at this point one element or one comment that was given by Dr. Ndung'u in terms of how the system is moving so fast, how everything, even the information that we collected in the range of practice report back in 2013, the way that the market is continuing moving kind of shows us that even the information we collected at the time is useful, but still didn't collect all those new developments. For example, in fintech and regtech, that are starting to be much more heavily discussed over the past couple of years. So I think the role of technology and how new innovative approaches and innovative tools could be used by supervisors, this is a topic that could probably be addressed in a different way in the revision of the guidance. There are some parts in the guidance that recognizes the importance of innovation, but I could see that some revisions or updates could be done in this new the update of this guidance document. I would also like to highlight the topic of regulatory burden that Daniel mentioned. In a way, indirectly, one point that the guidance document highlights is the importance of fomenting interinstitutional coordination, so that, for example, a central bank and a banking supervisory agency and a financial consumer protection agency don't request the same type of information 3 times from the financial supervisory agency. I think we mentioned the importance of much more strong coordination among multiple institutions, but there may be a way to even mention this topic even in a more clear way in the guidance document. I want to also agree with the importance of recognizing know your customer approaches, and I think the guidance did try to recognize the simplified due diligence approaches when we address the Basel Core Principle number 29, and also the annex on AML CFT issues. We would welcome any comments and any suggestions from the participants in this webinar in terms of maybe the guidance being even more clear or stronger when it's addressing this topic of simplified due diligence. We may have done it, and we may have seen or considered that the way we have addressed is strong, but maybe if any of you in the webinar consider that we haven't been strong enough, we welcome your comments so that we can address that maybe in a stronger way. We want to also recognize that the topic of financial exclusion risks has been included in the guidance document. We haven't explicitly said or talked about de-risking. The discussions within the Basel Consultative Group and the workstream try to go maybe to another higher level and talk more about the potential effects of financial exclusion risks and how sometimes over stringent requirements by supervisors on supervisees could have a negative impact on the provision of financial services to the general population and explicitly the underserved customers. So we looked at it from the highlighting of financial exclusion risks in several parts of the guidance document, but maybe there is a way of being even more upfront on this topic. So again, we welcome any comments by participants so that we can maybe give another look at how we've addressed this topic explicitly in the Basel guidance. One point that we've tried also to be strong, but we could have not been maybe as strong as our colleagues, our panelists would like us to be, is the topic of fomenting a much open approach by regulators and supervisors to technology. I think we have tried to mention in some points the importance of financial supervisors to deal with innovative financial products and financial providers so that they don't block new initiatives in this front, but that they welcome these developments, probably taking an approach of monitoring these developments so that the supervisors are not completely unaware of what's going on, but also don't block these new initiatives, but welcome these new partners and these new actors in financial sectors. I think for the first time, again, the Basel guidance has recognized the importance of these new types of actors, MNOs, third-party providers of technological services. The importance of for example, these new types of actors that are providing alternative credit scoring and credit screening models, and how they are new actors that could provide a very useful type of service to promoting financial inclusion. I think the guidance tried to go to address this topic from the importance of financial supervisors to know more about the actions of these new types of actors and to not prohibit or not block their work, but more be open to understanding what is going on in the system and to allow for their actions in a more, probably in a more aware way. But again, I think sometimes we go back and forth internally at the workstream level and at the Basel Consultative Group level, and the guidance is the result of internal comments and kind of trying to address both the kind of openness to innovations and the risk mitigation element that Beth had properly mentioned in her final comment. And we tried to kind of balance both aspects when we drafted the guidance document. And yes, we are open to hearing from comments from at this level of consultation process, so that we may be open to be more upfront and more direct on some of the comments in the guidance to recognize better the role of innovative providers and how supervisors could open their the role and the acceptance of these new providers in the regulation and supervision of innovative and inclusive financial services. So one point though where I'm glad to hear comments from both panelists on the importance of topics such as interoperability, interconnectivity, the role of payment systems. This is a particularly challenging topic for a Basel committee guidance. I think it's important to highlight in this process that payment systems themselves are also the topic of another standard-setting body, the Committee on Payment Markets and Infrastructure, which has been working on the role of non-retail payment systems, the role of innovative payment providers. So the Basel Committee, in a way, acknowledged the role of this other standard-setting body regarding the guidance on specific topics related to payment systems. I can, from a personal opinion and from a more CKP type of comment that I'm sharing, I think this may be that we may have an opportunity to even at least explicitly recognize the importance of interoperability and interconnectivity issues that I don't think have been addressed in the guidance paper. So maybe there's room at least to acknowledge the importance of this topic, and maybe even say that more strongly that there is room for more coordination or more work on this topic that the Basel Committee can do and could do along with the CPMI in terms of providing more specific guidance. I think one final comment before we open up to all other participants in this webinar is to say that the Basel Committee, I think it's important to recognize that the Basel Committee in this guidance document has taken a huge step forward to recognizing the importance of financial inclusion for financial stability. This is a huge leap, and I think this hasn't been done before, and it's important to recognize that this is at least a huge step forward. I know, and I completely agree with all the commentators here, that there is need for much concrete and specific guidance, which could be kind of a next level type of work that the Basel Committee could do in the future. I think it's important to recognize of the role of this guidance document of looking at this set of 19 core principles and how supervisors can look at those principles and to reconcile the importance of both financial stability and financial inclusion topics. So this guidance, yes.
Yeah. I'm sorry to interrupt. I'm just in the interest of time. I think you're winding down, but I'd just like to move it along a little bit. I want to reiterate, and I should have really said what you just said at the very beginning, which is that this is a huge step forward. It's a big deal for the Basel Committee to have come out with this. It does have it's really a shot across the bow for all supervisors across the world to think about financial inclusion in a different way. So, we can talk about all the things we wish the guidance said, but it needs to be in the context of this being a big step forward. We do have still a few minutes left for questions. And Sarah is just going to remind the audience how this works. Let me, before she does that, while you all are thinking of questions to ask, we've already received a few questions. And I'd like to pose two of them. One is particularly to Dr. Shidlowski and Ndung'u. We haven't spoken much about consumer protection, although it's been mentioned. I'd like to see if you could elaborate a little bit on the integration of consumer protection into the supervision process. And then we've received a number of comments about KYC and really the irony of a digital information-rich world in which people are still being asked to submit lots of paper documents and IDs at a time when you can go on the internet and scrape all kinds of information off of it about individuals. So why is there such a huge gap between the high-level pronouncements on this topic and what happens to customers on the ground? So those are two questions for you all to think about. Sarah's going to just mention the process for others to raise questions.
Great, thank you again to the panelists. I am sure there are a plethora of questions from the audience. Just to reiterate, if you do have questions, please either raise them verbally by hitting the raise your hand button in the GoToWebinar screen, or type your question in the question bar. We will do our best to get to all of your questions as they come into us. If you do have questions and comments that we're unable to get to during this webinar, we would like to take them into account. We encourage you to submit them to CFI by March 18th, or you can submit them directly to the Basel Committee by March 31st.
So can you all respond, panelists, please, to the questions that I posed already?
Sure. So let me start off with the second one. I have a very simple answer to why we're asking people, or why it's usual to ask people to submit all sorts of paper documents when it should be easy to have them digitally identified. And the basic answer is because most places the laws don't accept the digital answers as legally valid. If my signature is not legally valid unless it's on paper, then banks have a problem. So this all starts with the laws. It has to be substantial change and update. Not hard to do in principle, but it's got to go through 120 different legislatures for this to function. Now, you could have a movement for doing that, but so that's one of my simple answers. Now, on the second issue of consumer protection, let me say two things. One is that the way it's usually defined is that we really want to protect the individual, and then we forget that the individual is really part of a business household. A large part of the economic activity in emerging economies is undertaken by what are really business households. There is no clear line between the person and his business or her business. And so you really need to expand consumer protection to the protection of all small businesses that confront, in many cases, large institutions, at least proportionately. And so the small business needs as much protection as the consumer does, because they're just as much at the mercy of the large institutions that simply don't want to bother responding to smallholders. And the final comment on this is that this is a worldwide problem. When you take a mortgage in the United States, you have to sign about 80 documents that nobody ever reads. So there's a major issue here of putting things in language and in a form which the normal human being can understand and can cope with, and which is not burdened by legalese that turns out finally to be inoperable. And it's a fiction. It's a fiction that everybody's protected, and it looks fine on the books, but it's not real. And so, this requires a lot of work and a lot of attention. Over to you.
Let me add to that issue, the two questions that have been raised. Let me start with the KYC. And I said earlier that when we get into digital financial system, we can actually create a very versatile KYC framework. I would encourage on the 24th of this month, the Center for Global Development in Washington is going to launch its book on financial regulation for financial inclusion, or financial regulation for improving financial inclusion. There is a chapter on KYC, and it actually borrows an example of Kenya's risk-based approach in defining KYC, where we have a tiered approach, 3 stages of tiered approach. That is, you can provide information on the basis of if you're changing in terms of your transitioning. So essentially, the CGD has formalized this. But the most important thing is that the KYC can be made as comprehensive as possible depending on the country's database. But the most important thing is to understand that transactions can be categorized in terms of when do we require you to come and verify in terms of information. If you are a small trader, then all of a sudden you're trading quite massive amount of money, then you have to change it. It means you have changed your category. So here, this is where it's a dynamic setting in terms of KYC, and I would encourage that chapter on KYC and the risk-based approach and the tiered system. The tiered system is very, very important. Once the book is launched, you can look at it. It can be very informative. Then we can see how we can generalize in terms of how to come up with KYC issues. These are issues that actually discourage people going into the financial system because you cannot keep making a trip to the bank. And that is why DFS is being understood on that basis. The issue of consumer protection must go hand in hand with financial literacy as well. We would like to protect the small consumer of financial services, but we also need to make sure that they understand what is really happening. So essentially, I think I agree with what Daniel has said, but I think also we have to look at consumer protection. We haven't come up with a very clear guidelines in terms of what we need to do. This is still evolving. But the most important thing is that you cannot talk about consumer protection at the same time talking about financial literacy. The products that are coming into the market are quite complex. The products that are evolving in the market are also quite complex. We require to come up with very well-defined guidelines in terms of what do we mean by consumer protection and for whom and how much does. Thank you.
And I would just quickly say that the guidance document does include reference throughout the entire document on the importance of recognizing consumer protection as a key element of supervision of financial institutions. So this is another, once again, a very important message of this guidance document, that consumer protection has to be included into the supervision process, has to be taken into account when looking at the financial safety and soundness. So this is really key, really important. There is a small annex on that looks at the high-level principles on financial consumer protection of the OECD and looks at this from the perspective of prudential supervisors. But this is a key message that has been that we've tried to incorporate across this guidance document. And same in terms of the importance of financial integrity and the need of having to some more different approach to customer due diligence.
So let me, we've got quite a number of questions that have been typed in, and we can't possibly get to all of them within the time. Let me just remind you, there's a slide up there now that shows the address for submitting comments to both to the Center for Financial Inclusion and to the Basel Committee itself. We will be posting both a recording of this whole webinar and the slides that you've seen. They'll be posted on the CFI blog later today, and the website of the CFI blog is there on the screen. So let me just ask a couple of questions. One's coming in from Jim Wells. Why does the committee continue to tie financial inclusion guidance to the failed notion that non-traditional consumers need relationships with traditional financial institutions? So that's a very interesting one, and it connects with a question that has come in from Maria Jose Roa, in Mexico, the lack of trust in formal financial institutions is a significant barrier for inclusion. How do we promote trust in developing countries? Please, and anyone that wants to respond to that.
Well, I would just mention that, Basel Committee on Banking Supervision has the role of promoting the safety and soundness of the banking system. And I would, on the contrary, say that the Basel Committee this time around is recognizing the role of non-bank actors in the provision of financial services and to include the unserved and underserved customers. Again, this is a guidance that can be used by banking supervisors, and it also recognizes in the introduction to this document that this could also be useful to other types of authorities that are looking at microfinance institutions and non-bank financial services providers, even non-bank money users, and even includes the role of the telco regulators in terms of additional role in terms of providing information and helping supervisors to understand better the multiple actors that are providing financial sectors, financial services. I think it's important recognition from the Basel Committee of the importance of non-bank actors, the non-traditional bank actors, again with importance of trying to have a safe and sound sector that provides services to financial consumers. So, I think it's trying to recognize that you can not only look at prudential issues, financial stability topics, but at the same time to look at financial consumer protection topics, looking at inclusive practices so that this combination of aspects, integrity, consumer protection, stability, inclusion, all of them promote a much better system for consumers so that they can actually have more trust in the formal financial sector.
Yes, so maybe let me say just 2 words about trust. Trust is something built up over time, and it involves responsiveness on the part of the party wanting to be trusted. If banks and financial institutions are distant from the consumer, distant from their customers, and non-responsive because they lay down the law, and this is the way things have to be, and you either adhere or you don't, then it's going to be very difficult to build trust. That's why the money lender has trust, because he's flexible. That's why some NGOs have trust and are trusted, because they're flexible. That's why some intermediate and some interesting new kind of institutions that are in cooperatives and semi-cooperatives, and there's a variety, there's a whole range of institutions that are trusted by their memberships and their customers because they are responsive. Insofar as financial institutions are distant, are rule-bound, and have no flexibility, they're going to have continuously a problem of developing trust. And it's going to take a long time. It's just not going to happen. It's closeness that generates trust, and it's stability. It takes time. And so this is something that needs to be recognized, and therefore there's some issues that I deal with in my longer comments that we don't have time to deal with here, as to how you should really develop a longer-term plan for inclusion, financial inclusion, and you should insulate from the cycle so that financial inclusion will build over time and become solid, and it really become a part of the system.
Yeah, actually, to add to that point, point that Daniel has mentioned, actually you can understand that trust is weak or is absent when you look at when most potential clients of banks look at the failure of regulatory technology in the past. And what is happening now is that if you combine the Basel Committee, they are trying to develop some blueprints of regulatory capacity, look at the digital financial services system is transparent. This is where trust is being built. Trust is being built because the digital financial services is being transparent. It is seen to be transparent. Regulators are coming out strong, and actions by, for example, this Basel committee are helping in terms of building a revolutionized regulatory technology that can be trusted in future. It is the presence of weak banks and weak regulators that has actually destroyed the trust over time. And this is something that we should actually try to cross in and try to combine forces so that we show that it's trying to coping with the technology and using technology to help you in terms of not only building trust, but being effective regulator in the market.
Thank you. We will. We're just about out of time now, and I'm so sorry that we aren't able to get to more of the questions, especially those of you who raised your hand to speak. I'm just very sorry not to be able to call on you. We just have. But what I will promise is that those of you who wanted to raise a verbal comment, if you type your comment in, we will do everything possible to get responses to you, to all of those who have typed in questions. And so just before we close, I'd like to give each panelist a chance to make one final comment, very brief. And one of the things for Juan Carlos, if you could go first and just in your comment, talk about or mention how fast or how frequently one would expect the guidance to be updated, and when it would come into effect, and how often is it going to be refreshed? Just a process question that's come up here in the comments. So let's start with you, Juan Carlos, and then go to Mr. Ndung'u, and finally to Dr. Szydlowski for the last word.
Thank you very much, Beth, and thank you to the panelists for all these very valuable comments. And thanks to all who have participated in the webinar and have sent their comments. I would appreciate and welcome and encourage everyone to go to send their comments both or either to the Basel Committee directly or to the Center for Financial Inclusion. I think this is a very important document, and the Basel Committee will be very open to listen to everyone that has a comment on how to improve this document. I'm also speaking on behalf of CGAP, and as part of the member of CGAP, we want all these comments to go to the Basel Committee from all these different stakeholders. So please go and submit your comments. As all of you may understand, this is the standard setting body that has multiple layers of revision for these types of document. The process is expected to take a few months from the time that the consultative process ends in March. So we think that it would take about probably 6 months between the end of the consultation period and the time where the final document would be published. So it's an approximate based on what happened last time around. In 2010, there was a guidance on microfinance activities, the application of BCPs to microfinance activities that also took about a similar time from the consultative period to the final version of publication. So in terms of the future, it depends. It's difficult to say when a new guidance will come up, but I think that if there are as many comments as we expect, this could give also a good signal to the Basel Committee in terms of the interest of multiple stakeholders for the Basel Committee to do much more on this topic of financial inclusion, and maybe come up with other types of documents that can complement the guidance or provide some other types of information to relevant stakeholders. So thank you, and please submit your comments.
Thank you very much. I think for me, let me, instead of having to repeat the comments that I've made, let me refer you again to Task Force report for Center for Global Development, which will be launched on the 24th of this month. They have come up with 26 recommendations, which are very, very important, perhaps even to shed light in terms of this. And they are divided into 4 areas: competition policy, Then there is leveling the playing field, that is competition policy. And then, of course, know your customer designs and even the the retail payment system. I think with these recommendations, it means that we are having a wealth of information that we can use to regularize and come up with blueprints for regulators to use. And I think they can be applicable across countries. So as we get more and more information from works that have been done both by Basel Committee and also these institutions like the Center for Financial Inclusion, Center for the Global Development, we are going to get more data points that can help us regularize and come up with perhaps more comprehensive guidelines in terms of how to encourage the market to grow. And I believe that is the way to go. Thank you very much.
All right, a final word from Daniel Shedlovsky here, sitting in Lima, Peru. I want to commend the Basel Committee for its work, and I want to commend CGAP and all the people who have been involved in doing this. I think it's an enormous step forward, that there is more to do, that for sure, but there's always more to do. I think this has been extremely productive. They've taken an enormous step forward. And now with the revisions, they're probably going to do even better. And this is going to turn out to have been a major contribution. We look forward to seeing what finally comes out, and then to collaborate, all of us in the collectivity of people who want to make the world a better and safer place. This is a major contribution, and we need to really thank the Basel Committee for having taken this initiative, and for Juan Carlos for, having shepherded it along with his colleagues. So Juan Carlos, thanks to you, and please pass along our thanks to all the others that have been involved.
Okay, well that wraps it up. I'd like to thank each of the panelists for your willingness to participate and also for the knowledge and care that went into all the comments you've made. I also want to thank the CFI team who put the webinar together. Elise McGrath, Neil Kennedy, and Sarah Samuels, thanks so much. And for all of the rest of you, I'd like to remind you, send us any comments you have, submit comments directly to the Basel Committee, and check out the CFI blog either later this afternoon or tomorrow. Preferably tomorrow might be a safer bet. And you will be able to access a recording of the webinar and the slides from the webinar. The final version of Dr. Shedlovsky's paper will be available from CFI in early April. And I thank you, all of the audience, for your interest and your questions. Have a good day.